Business as usual isn't good enough anymore. The future belongs to the technology-advantaged power broker. Power brokers get more deals done faster with RealNex, the most complete commercial real estate technology solution for fast lead generation, complete financial analysis, beautiful presentations, stimulating marketing, and successful deal management. With RealNex, power brokers quickly profile people and properties to most efficiently prospect for new business, manage deals, and report on activity. No one knows the market better than a RealNex power broker. They have complete data on market inventory, comparable sales and leases, hidden spaces, and the most active buyers, sellers, and tenants. They efficiently collaborate with clients using the RealNex Tourbook leasing app and run accelerated sales processes in private and secure deal rooms. Power brokers eliminate redundancies and save time with automated investment and comparative lease analyses, and they swiftly create an incredible array of professional, elegant, and consistently branded marketing materials. When it's time to go to market, a RealNex power broker can economically run highly targeted e-marketing campaigns to their private prospect lists, or instantly tap into the vast RealNex community to assure no stone is left unturned. Power brokers can even leverage 3D virtual reality to improve deal cycle times for buildings and spaces, and instantly assure clients the space works perfectly for them. Power brokers effortlessly impress their clients to instantly save more time and make more money. The future is now. You too can be a power broker. Boost your results. Sign up for RealNex today.
This is Jeff Fisher, and this is on behalf of RealNex, drawing a lot of data from NCRE, National Council of Real Estate Investment Fiduciaries, which tracks over $500 billion of property from institutional investors, but also drawing upon other property types and other sources of information, I should say. As an overview, I said this is kind of deja vu from last quarter, which is good. We don't like surprises. We like to see that markets are moving along in kind of a predictable manner. Retail returns continue to be positive. I should say they turned positive for the first time. The other property types continue to remain positive. Retail had dipped into negative territory last quarter, but moved back into positive territory this quarter, which is good. The market value index, which is a price index, rose again this quarter. So it didn't peak last quarter. We still don't know whether this quarter was the peak or not, but hopefully we'll continue to see market values rise at least a little bit every quarter, as it has been recently. Industrial, no surprise, maybe is still the leader of the pack, that being, of course, warehouse space. Cap rates remain at all-time low levels, and occupancy continues to be at high levels. This is all the different asset classes that we like to track, with the second set of bars being the NCRE Property Index, which is an index of unlevered returns on institutional real estate, shown for the most recent quarter that ended September 30th, along with 1 year, 10-year, and 25-year. I jumped to that because the one to the left of that that says NFI Odyssey, a little harder to explain. That's an index of the performance of funds that hold the properties, open-end, closed-end funds that are investing in the various properties. Returns are pretty similar. The main difference is there's some leverage on that the funds use when they buy the property, so that is a levered index. Although not a lot of leverage in the market right now. There's also a index of the returns on the properties that have leverage, and that's the third set of bars, the NPI levered, and you can see those are a little bit higher returns. All returns are pretty low this quarter, except for NAREIT. NAREIT is the National Association of Real Estate Investment Trusts, so that's the return on REITs. And as noted on there, that really benefited from the lower interest rates that we have on in the market right now, and I've been told that a lot of investors are kind of viewing REITs as a bond alternative, more like a fixed rate security, at least in the short run, because of the higher dividend yield that REITs tend to pay. But in the long run, as you can also see, if you look at it over 10 years or 25 years, and I have circled there the NPI levered as well as NAREIT, you see that the returns are really pretty similar between unlevered real estate and I should say the levered real estate and what you see with REITs over like a 10-year and a 25-year time period. And in the long run, the two tend to behave in pretty similar manner. I wanted to show you the index composition. I haven't shown this before. It would give you an idea where institutional investors tend to want to put their investments. You can see on the left where I have the different property types: retail, office, apartment, hotel just rounded down to 0. There are some hotels in the index, but very small number of hotels. So you see office is really the majority of the investment, always has been, followed by apartment. Apartment has really increased a lot since the '86 tax law change. That kind of goes back a long time now historically, but before then you hardly had any apartments because it was all the syndications. Retail 22%. Industrial is the lowest percentage, but no surprise that's been increasing in recent years, although it takes a lot of industrial properties to make a difference in terms of the market value. As you know, industrial properties tend to be a much lower value per square foot. You can also see the allocation across geographic areas, the West the largest, followed by the East, South, and then the Midwest. Matt, if you want to jump in, I don't know if you're set up to do the polling that Jeff was going to do. Matt, can you jump in? Maybe not. Okay. So let me just move forward. What we're going to ask is, we've done some polling in the past. What do you think the best performing asset class will be for the fourth quarter of 2019? And I suspect most of you would either pick the levered private real estate or maybe stocks. They're both kind of at high levels right now. Or it could be REITs, as we saw, REITs did real well last quarter. So kind of hard to tell which one is going to be the best. They're all kind of at pretty high levels right now. A lot of uncertainty in the market. Again, you see how the NCREIF Property Index total return has been from 16.1 through 19.3. Also on this graph is the open-end diversified core equity fund property returns. That may be a little confusing. I mainly put it on here because those properties tend to be valued more frequently, as I noted, and the fact that those were headed down more than the overall properties in the index was a little disconcerting up through the current quarter, but you see that's come back up again. So that's kind of good news. It's a sign that maybe things have kind of stabilized in what's happening to returns in the property market. Over a longer period of time, from 1999 through 2017, you see the returns, you see the effects of the recession, but more important, you notice how returns have pretty much leveled off in the last couple of years, which is kind of unusual. We don't usually see that long a period of time with returns at almost the same level and not moving into the negative territory. The appreciation return is like a change in value of the properties, and you see that that's remained positive. That's been above 0, and hopefully will continue above 0. And then we see the components of the return, which I've talked about previously. If we break down the return in the components, it's like, well, I need cash yield, I need NOI growth, I need cap rate change, although we see the cap rate change only helped us up until about a year ago. Cap rate changes were helping us as cap rates came down, and that resulted in values going up. So we can't really rely on cap rate changes to help us going forward, I don't think. It's hard to imagine cap rates going down much more, although I was reminded hearing a presentation from somebody at LaSalle Investment Management just 2 days ago that interest rates in Europe are negative, and in many other countries are much lower than the U.S., and they're seeing cap rates that are even down to the 2% range. So I guess it's possible that cap rates could come down some more. If interest rates go up, that would tend to put upward pressure on them. Most likely scenario is probably that they're going to stay around a certain level, at least for a couple more quarters. This will give you an idea of the number of properties that have been written up versus written down, which tends to track highly with the actual returns, which is the blue line. Blue line is the returns on the right axis, and then write-ups and write-downs. It's just kind of another way to get a sense of what's driving the market one way or the other. There's always some properties being written up and some properties being written down, even when the market is really weak. But you can see the number of net write-ups over write-downs has been dropping off, as we would expect with the lower returns that we have going on in the market. We also took a look at that for retail properties just to get a sense of how that might look compared to the other property types, since retail, as we know, has been pretty weak in recent quarters. And you can see that the net write-ups minus write-down has dropped into the negative territory for REITs. I guess no surprise there. There's more not REITs, but retail properties, more retail properties that have been written down versus written up over the last couple of quarters. So again, we were going to ask if we could do the polling, which we won't do, but what's do you think would the unlevered total return would be for institutional real estate for the fourth quarter of 2019? It's currently around 1.4%, and I can tell you that the institutional investors thought it would pretty much stay in that same range. They didn't see the returns dropping below zero, or really dropping much less than where they are. They kind of thought it would be in the same range of around 1.4%. So they kind of voted that the 1 to 2% range was the greatest choice. Now you see the returns across the different property types, and again, as I kind of alluded to earlier, industrial properties doing quite well. I think that was a little bit down from last quarter, but 3.2% on again, unlevered return on a quarterly basis. So, that's like over 12% return if you annualize it. And of course, if you levered that up, it'd be even higher. These again are unlevered rates of return for just the quarter. So very strong performance for industrial properties, and really not bad performance for all the property types except retail at only 0.2%. Positive, but that would be less than 1% on an annualized basis. And then the returns by property type on a longer term basis from 2012 to 2019. You see that again disparity where they were all not too far apart, going up through about 2015, and that's where you really saw the industrial properties, held up, driven by the strong performance at warehouse, and you really saw the retail properties drop down, and the other properties all kind of in the same range, but having dropped down from certainly the historical high returns that, or at least in recent years, high returns that we had in 2015. So our price index, as I mentioned earlier, did reach a new high. That's the red line is an index of price levels. So, real estate continues to reach new highs, even though it's just slightly higher than last quarter. It's reaching new highs. And if you do an index of net operating income, it's also been rising, although it kind of leveled off this last quarter, but overall, it's been rising at least since 2009, and actually pretty steadily over the whole history. Nice thing about real estate is those existing leases do keep generating that net operating income. As noted, the widening gap that we have between the market value index and the NOI index was our decrease in cap rates that we had that caused us to, I guess you could say, pay a higher price for the same level of net operating income. So prices went up faster than the net operating income went up. And as I said earlier, if cap rates aren't going to decline much more, although they could, then that gap is not going to continue to widen, but should still rise as long as net operating income is going up. So when we asked the institutional investors what was going to happen to market values, whether they were going to peak this quarter, or is it going to be next quarter, or sometime maybe next year, most thought it's not going to be until sometime next year, and many even thought it would be after the first quarter of 2020. So nobody really thinks we're at the peak of the market right now, which is good. This is the cap rates by property type, and as I keep saying, cap rates, as you can see, much lower levels than they were back in 1999, and really, even if we went back to when the index started in 1978, this would be the lowest level that we've ever seen in cap rates. I'm always surprised that industrial, up until this quarter, were the highest, given the demand for warehouse space. Those actually have come down below retail this quarter. No surprise maybe that retail cap rates went up a little. Less growth expected for retail. Less growth means higher cap rates. Other property type cap rates kind of holding in the range that they're at those all-time low levels of cap rates. Apartment being the lowest of all the property types. I think part of that reason is that apartments not only may be considered a little bit less risky than the other property types, but don't require the same amount of CapEx as the other property types. This is a graph that also shows the cap rates, but based on a broader set of data that includes non-institutional properties that comes from Real Capital Analytics and CBRE research. But kind of the same story. You see the decline in cap rates. This starts 2005 through 2019. The cap rates are again at low levels for this graph, but a higher cap rate than we have for the institutional real estate, because this includes going down to a much smaller range of property values. The Real Capital Analytics data tracks every property that's sold over $2.5 million in the U.S., whereas the institutional properties would probably have a low of maybe around $30 million. This is acquisitions less dispositions in the blue line, to give you an idea of how many properties were sold versus how many properties were acquired. And that's also on the same graph with the cap rate spread over 10-year treasuries. I was asked to add this for the webinar for the institutional investors, to sort of see if maybe the net acquisitions is telling us something about the relationship between that and the cap rate spread. Like if you go back right before the recession, the cap rate spread had just gotten really low, and with that low a cap rate spread, maybe it's no wonder that the number of acquisitions started to drop off as people got concerned about the low spread that we had. So moving to where we are right now in 2019, you saw that cap rate spread was kind of coming down until about a year ago, and you see that cap rate spread has been going back up again. Again, that orange line. So cap rate spread going up is good. We've got a nice risk premium over the 10-year treasuries. It's about 3% right now. You see it gotten down to well under 1% right before the financial crisis, whereas now the spread over treasuries, the premium you're getting for real estate, at least the institutional real estate, about 3%, and for the non-institutional real estate, as we saw from that previous graph, would be even higher. This gives you an idea of acquisition volume, which Real Capital Analytics also tracks, and you can see that commercial real estate acquisition volume, even though the net acquisitions over dispositions has been kind of dropping, we still have pretty healthy acquisition volume. In fact, it's gone up this quarter, and it went up last quarter from what it had been 2 quarters ago. So still pretty decent acquisition volume. This is net leased acquisition volume, but kind of gives you an idea of what's happening in the overall market. And acquisition from cross-border investors coming into the U.S. versus institutional investors, REITs, and private investors buying commercial real estate. They're all up this quarter from where they were last quarter. So sort of healthy, again, acquisition volume across all the different groups that tend to be buying commercial real estate. And then you see the country of origin for the institutional capital and what property type it tends to be going into. No surprise maybe that industrial is getting the bulk of the capital, retail getting the least. In fact, retail doesn't even show up from some of the countries as something that's on their radar screen. I see China is only buying industrial property in the U.S. Kind of interesting. Canada, the source of the most cross-border capital, followed by Germany, which again is mostly well, in this case that's mostly office properties. So you do have a big difference there in sort of the interest of the German investors for some reason versus the Chinese and the property type that they're buying. And this again is looking at the country of origin of the investment in the U.S. Kind of breaks it down into what percent and amount you're getting from each country. In this case, the billions of dollars from each of those countries. And then again by property type over time. So Real Capital Analytics tracks this data and tends to be followed by most of the different institutional investors. This is the net operating income growth. See, that's 1999 through 2017, how NOI has been growing on the properties. If you look at the retail, you see that pretty low, although still positive, but it actually went up a little bit last quarter. So that's consistent with the fact that returns went up a little bit last quarter. Industrial has the strongest NOI growth. Maybe that's no surprise, but really the NOI growth on all the property types is really pretty good. Office NOI growth is second to the industrial, kind of come on strong from where it was a couple of years ago. So we're really seeing decent NOI growth all across the board for commercial real estate. And then real estate pricing. This is just another look at the cap rates, but looked at relative to 90-day treasuries, and then also relative to the BAA bond yields, which of course are the riskier bonds. It's kind of interesting. The cap rates really track pretty closely with the BAAA bond yields. But again, you know, we have cap rates above even the AAA bond yields at this point in time. And then, you know, quite a bit of a premium over the 90-day treasuries. Most of the institutional investors thought cap rates would pretty much stay at the current level, not increase, not decrease. There doesn't seem to be much reason why cap rates should move in either direction at this point. The Fed is, you know, not really trying to push interest rates up at this point, but since we're at record low levels, we don't really see cap rates really dropping much either. So kind of staying around the current level. Occupancy is really at all-time highs. You can see where, you know, well above 90%, aside from hotels where you never expect that kind of occupancy, but 90% or above on all the other property types. And not sure it's possible to get to 100%. Never seen that before. So we're really at all-time highs for occupancy. So what we call the space market, a lot of times the market for tenants is, with the NOI growth being relatively strong that we talked about earlier, and occupancy at high levels, that looks pretty good right now. Flipping to vacancy, just the flip side of the occupancy, you can see how vacancy coming down for office, kind of holding steady for retail properties, despite everything that we're hearing about retail properties. The occupancies and vacancy has been holding steady, has come down a little bit for the other property types. And then drilling into the property subtypes a little bit, we see the overall apartment index, but then what's happening with returns for garden apartments, low rise, and high rise. So high rise not performing as well as the garden apartments. Quite a difference there. Just a lot of interest in recent years, more capital going into the garden apartments than the high rise apartments. And then with office properties, we look at it in terms of CBD versus suburban. And there you see that the CBD office has been doing the best for the last couple of years relative to, I say suburban, the suburban office doing the best relative to the CBD office. You can see it's kind of flip-flopped through time in terms of which one is doing the best. And then turning to retail, we see that it's really the regional malls and then the super regional malls that haven't been performing as well as the other retail. I think probably it's, with the regional and super regional malls where they're most affected by the store closings that have been taking place, not so much with the community and neighborhood centers. Quite a difference actually in that spread that we have in recent years compared to when you look back like around 2015, not as much of a spread across the different subtypes of retail properties. And then with industrial, really even though we track the light manufacturing and R&D and flex, really almost 90% of that return is coming from what's happening with warehouse properties, which is the highest on the graph here. And then we do track property types like assisted living, independent living, and self-storage, and those returns are all really pretty good. I think those have actually been outperforming all the other property types in recent years. I think more and more institutional capital is starting to move into some of these other property types. And then looking at it across some of the major CBSAs, you see San Francisco, LA at the top, and you see Boston near the bottom there, New York. A lot of capital went into those CBSAs several years ago, and those haven't been performing quite as well in recent years. And then this shows you where the investment capital has been going. You see capital still going into New York. That's has had the most acquisition volume. New York, followed by Los Angeles, followed by San Francisco and DC. So even though performance in some of these areas hasn't been as good, although others have been, you see that the acquisition volume still remains at pretty high levels. And then agricultural properties, which is also tracked. You can see farmland and timberland hasn't done quite as well, but holding steady. Best performing sector in 2020, the institutional investors all thought that it would continue to be industrial properties. We thought, there might start to change next year since there's been such strong performance and capital going into industrial, but that still is certainly the favored property type. This is the capital flows into and out of the real estate funds. And here you can see it has turned slightly negative. There are some funds where investors want to take capital out, and so there's more capital coming out than going in, but it hasn't really turned that negative that I don't think there's a big concern now about capital flowing out of the different funds that buy these properties. I threw this up there because it's very recent news, and in a conference that I was at earlier this week, I heard some concerns being expressed about this. So the headline I grabbed here, the Fed's repo bailout and JP Morgan's 38 trading floors. And now that's not to suggest that it's JP Morgan that's in trouble at all. I think maybe they just thought that was a neat graphic of the one of the trading floors, but evidently the Fed has just pumped a lot of money, trillions, into the repo market, which is overnight borrowing of money over the last couple of weeks, and there's just a little bit of concern there that could be a problem going forward if the Fed has to keep pumping money into the repo market because the banks have not had the capital to supply for that overnight lending. So it may be something to kind of keep your eye on. It's not directly related to what's happening with commercial real estate, but we all know if all of a sudden there's a capital shortage that could turn out impacting commercial real estate as it did during the financial crisis. And maybe that should be on the list here of things that could impact commercial real estate, but the Fed changing interest rates seems to be a little bit off the table right now. There has been a global slowdown in China and Germany. I think the institutional investors are still most concerned about the trade war, and of course, any of these things listed here could cause a recession. On the other hand, nobody really sees a recession around the corner. So, kind of a summary. Gave a quick update this quarter. Retail did turn positive, I mentioned, and all that means the returns on all the property types are in the positive territory. The market value index rose again this quarter, so it didn't peak. Property values are still rising. Industrial is still the strongest performer. Cap rates remain at all-time lows, and occupancy continues to be at all-time high levels. So if the news continues to be like this for next quarter, I think we'll all be pretty happy and business will be good. So that's all I have for this quarter, and look forward to seeing everybody next quarter.